Trading or investing in crypto is of course a complicated affair because there are so many factors that can influence the prices of different assets. This includes on the one hand tokenomics and supply dynamics, so the amount of tokens or coins that are available on the market, as well as of course news and the way the hype cycles move between different sectors of the crypto space, and certainly global events that affect all financial markets from stocks to crypto. But in the final analysis, what it all comes down to is decisions on whether to sell or buy something. So the market, of course, only moves because people are buying or selling. If you want to be successful, of course, you have to understand these dynamics. You have to know why and when market participants will be more likely to sell or to buy something. To do this, you first need to focus on a specific time frame, or rather on a specific style of approaching the crypto markets. Now, in general, there are two main types of this. There is trading and investing. And here you need to know which one you are more interested in and which one you are more talented for. So investing refers to buying something and holding it over a longer time frame. This can be often years or even decades. Well, in crypto, of course, it hasn't been decades so far, but presumably that is a time horizon that should be taken into account for the future. In any case, investing refers to these longer time frames, and the reason one would invest in a particular project, so a particular token, is that one believes that it will go up in value, of course, over the long term, that it has real use cases, and that it will gain adoption in the long run. Investors are typically more or less unfazed by short-term price movements, and they aim to pick a project that will be successful years and years down the line. Trading is different. Trading refers to mainly buying and selling on much shorter time frames, so sometimes buying and selling multiple times in a single day, and it involves a different risk profile. So traders typically aren't that interested in how solid something is as a project, so how fundamentally potentially valuable it is, but rather they are interested simply in looking at the charts and making their decisions based solely on the way a chart looks at a given time. Of course, they can take certain other things into account, such as important news headlines or other events that could influence the price, but the bottom line is that they mostly look at a shorter time horizon. And this means, of course, given how volatile crypto is, that there is a considerable level of risk here. Because whereas with investing, you typically have quite a bit of time to make the analysis that you need and to decide on what you want to do, with trading, you need to make relatively fast decisions quickly and consistently. And of course, given that trading involves more transactions, more trades, that means that in case those trades are losses, those losses can very quickly add up to quite a lot. One interesting and relatively predictable dynamic in crypto, which is especially relevant for investors, but to some extent also for traders, is the way that money flows in the crypto market. Now, crypto, of course, has market cycles, which are sort of periods when the market is extremely bullish, so the prices go up by a lot and then, of course, drop back down again. Now, these cycles themselves aren't completely predictable. They used to be sort of regular during the first part of crypto's history. Of course, this would be more or less until around 2021, 2022. Because crypto was mainly driven by speculators, which were more or less on the fringes of the economy. So it wasn't really driven by institutions and the sort of traders that drive the stock markets or the forex markets. As crypto is adopted more and more by the biggest players in the market, so the institutions and the huge hedge funds, it is likely that it won't be that predictably cyclical. There are still, however, some aspects of this cyclical nature that will probably persist at least for some time. Now, one is the money flow. This basically refers to how money flows through different parts of the market. The way it typically works is that it first flows from fiat, so from US dollars, euros, and so on, into Bitcoin. And when that happens, Bitcoin tends to pump, so the price goes up dramatically. And this happens for a while, as long as there is sufficient buying pressure. Then at some point, Bitcoin stagnates a bit. And that is when investors will typically get essentially somewhat bored with what's happening with Bitcoin, and they'd want to put their money somewhere else, somewhere where it can bring a higher profit and in an asset which is more volatile. So at that point, they'd move into altcoins. Altcoins are, of course, all the cryptocurrencies apart from Bitcoin, and some also consider Ethereum to not be an altcoin exactly, but that's a different matter. In any case, money will move into the large caps, so the cryptocurrencies other than Bitcoin which have a large market cap, which are among the largest. And then those assets, of course, due to the buying pressure, will go up in price. And again, a similar thing will happen as was the case with Bitcoin. Those will stagnate, and then money will move into mid caps, which are somewhat more volatile, riskier, and can also, of course, bring larger returns as well as larger losses. Those will pump at some point, those will stagnate, and then finally it will move into low caps, so smaller projects with lower valuations, which can increase in price by multiples and indeed orders of magnitude relatively quickly. And then when the low caps are done, the money will go back into fiat, then Bitcoin, and the cycle will repeat. Of course, the cycle isn't a completely predictable linear affair, because that would simply make it too easy, and the markets don't work that way. So there are a lot of additional dynamics to keep track of throughout different phases of the cycle. One of them is Bitcoin dominance, which expresses the percentage of the total market cap of cryptocurrencies which is taken up by Bitcoin. This is a good way to monitor which part of the cycle the market is in at any given time, and also which other parts are, of course, likely to come. In any case, sudden moves happen in crypto very often, and they can have different effects. So, for example, if Bitcoin climbs heavily and suddenly, all altcoins are very likely to drop in price. Sometimes they won't drop in price relative to the dollar, so to fiat currency, that much, but they often will, and in any case they more or less always will drop in price relative to Bitcoin. Also, if Bitcoin dips suddenly, then that will also almost always lead to a dip across the board, simply due to the fact that cryptocurrencies as a market sector are incredibly correlated with one another, and especially with Bitcoin. So whichever move Bitcoin makes, that is very likely to impact the entire market very quickly.